Esteemed members, good evening to each and every one of you. It is a fine evening today. Myself, CA Rajendra Kumar, the Chairman of the Board of Internal Audit and Management Accounting. On the screen, you see the wonderful personality of CA Charanjot Singh Nanda. And to my right, let me have the great pleasure and privilege of welcoming CA Durgesh Kabraji, the Chairman of the Committee for Members in Industry and Business, and also a person who is very, very closely knitted to the financial reporting through the Center for Audit Quality. Ladies and gentlemen, we have here CA Gurvinder, who is going to make us a presentation today and lead us through the internal controls over financial reporting. Today marks a remarkable day in the history of a very young chartered accountant who just qualified in the recently announced results. Today marks a pinnacle in his journey in the world of academics, in the world of public speaking. Ladies and gentlemen, with enormous amount of happiness, with large joy within our folds, please allow me to welcome CA Ivpreet Singh, who is going to be the moderator of the program today. Friends, CA Ivpreet Singh is the brilliant son of the debonair of the wonderful CA Charanjot Singh Nanda. So the father and son duo are all on the screens with the same color of pagdi. Maybe that is by choice or by chance. That I will not comment or I don't know. But ladies and gentlemen, it's a wonderful day today in our board. Our secretary, CA Aarti Bansal, you can see on the screens also. And to my left is Arun Agarwal, a dynamic staff of our committee. Ladies and gentlemen, before I invite Charanjot Singh Nandaji to deliver his formal address, it is my privilege to welcome and invite CA Durgesh Kabraji to give his address and also motivate all of us in the field of financial reporting and the related internal controls. Durgesh Kabraji is a Central Council member from the Commercial Capital of India, Mumbai, from the Western region. We welcome you, sir, and thank you for sparing your valuable time.
Thank you.
Sir, we eagerly look forward to your remarks as a person who is closely related and closely working in the world of financial reporting through the audit quality. Please, sir, the floor is yours.
Chairman, sir, Rajendra Kumar ji, Vice Chairman of the committee, Charanjot Singh Nanda ji, Moderator, Ivpreet, and the speaker for today, Gurvinder Singh ji. And it's indeed a pleasure for me to be a part of this webinar, which is there on ICOFAR, Internal Control over Financial Reporting. Friends and dear colleagues, let me tell you that for the better corporate governance in the corporate world, ICOFAR is must. Internal control which are being laid down, penned down in any corporate or in any organization has to be properly followed. And whether these have been properly followed or not, there the auditor needs to report. This was a great opportunity for all of us when this was made mandatory. Some of us have taken advantage of internal financial control system to be developed and penned down for their clients, but some of us couldn't take the advantage of that opportunity which was offered to us by the government through the Companies Act. But let me tell you, friends, still the time has not gone. And this is the area where we chartered accountants, as a consultant or as a person who is dealing in the corporate, as the person in charge of the financial reporting and financial statement, can take care of and can have the better internal control systems laid down in the organization. These are the various control systems which normally helps to all the corporates for achieving the best as far as the financials are concerned, and how the things can be controlled if there are some divergence from these internal financial controls let down. So this is very important, and I am sure that today it will be well deliberated by Gurvinder ji with the help of Upri ji. And friends, let me tell you that these two gentlemen, Chairman Rajendra Kumar ji and Vice Chairman Charanjot Singh Nanda ji, is doing great job in this committee as far as concurrent audits are concerned, as far as internal audits are concerned, as far as management, financial management course are concerned, because this committee this year has the combination of two management accounting committee and which was there earlier and the internal audit standard board. So this is a combination of two, and the responsibility have increased, and these two people have done wonders in this committee. Every Wednesday, this committee is having the program under the leadership of Charanjot Singh Nandaji and Rajendra Kumarji to deliberate on various subjects and build the skill set of our members so they can provide the best of their services to their clients, as well as the person who is working into the corporates and organizations can perform better over there. Not only this, these two gentlemen have visited many times to all government organizations, including CAG, and told them that what is the importance of internal audit and how it has to be taken forward in all the government companies, and how the chartered accountants can play a better role into the internal audits. This is what has been conveyed by our both the leaders of this committee, and I am sure that the efforts put by these two gentlemen will definitely bring the fruits, and our fraternity is going to get more opportunity. With this, I must thank these two gentlemen as well as Gurvinderji and Uprit for having wonderful deliberation going to take place, and wish everybody who has joined virtually to have wonderful learning today. Thank you.
Thank you, Durgesh Kabraji. You have rightly proved that you are a man of financial reporting and internal controls through your brief talk today. We are very happy that you joined us at such a short notice and honored us. We are really grateful to you for your being with us today. Charanjot Singh Nandaji, all of us, like always, are eagerly waiting to hear you. Over to you,
Thanks
sir.
a lot. Thanks a lot, the Honorable Chairman of the Board, C. Rajendra Kumar, more commonly known as the GST man, a man who has changed the entire landscape of the board. Seated left to him, because I see him at the left side, C. Durgesh Kabra, Chairman Committee for Members Industry and Business, a pioneer who has led the profession from front and ensured that young chartered accountants get their proper representation when it comes to the industry. They are able to rightfully claim their livelihood, and more importantly, the job description which they intend to serve. I have with me the speaker of the day, C.A. Gurvinder Singh, who's like my younger brother, C.A. Arti Bansal, the secretary, the moderator of the day, C.A. Ivpreet Singh, technical support, Ayaz, Gyan, Arun, and all participants have come here to go home more enlightened. Ladies and gentlemen, today's topic is a very, very nice topic, which has a lot of ramifications in the coming times. ICFR. ICFR refers to the controls specifically designed to address risks related to financial reporting. When you speak of internal audit, it cannot be devoid of risk. and risk reporting is most important. If you speak this in simple terms, a public company's ICFR consists of the controls that are designed to provide reasonable assurance that the company's financial statements are reliable and prepared in accordance with the generally accepted accounting principles. Before I conclude, I should tell you that there are 5 interrelated components of the internal control framework which shall be taken by Gurvinderji. They are the control environment in which the entire working is being done, the risk assessment, where you understand how the risk has to be taken into account and how, in case a risk comes in, how it has to be mitigated. Third is the control activities. There is a well-known saying that where controls diminish, fraud starts emerging. The fourth is information and communication. And last is monitoring the entire process. So, ladies and gentlemen, we have to effectively monitor the entire financial processes and control environment to ultimately ensure that the results are magnificent, are really fantabulous. Ladies and gentlemen, as professionals, we have worked very hard to touch unprecedented heights. But the most important thing which we need to understand is that we all have to work in tandem with creating value and worth. So for that, we invited Mr. Gurvinder Singh, who's a very senior chartered accountant and who has got a deep insight into the working of internal audit and himself is a very celebrated internal auditor. He's a chartered accountant and BCom. He has with him 15 years of experience in assurance and risk management, experience ranging across multiple sectors such as financial services, insurance, infrastructure and real estate, manufacturing, telecom, oil and gas, sports associations, FMCG, hospitality. He is, prior to becoming a practicing chartered accountant, he was associated with large corporates and consulting firms, and he has been involved in number of special projects like ICFR and internal audit assignment for various listed and unlisted companies. He has been engaged in process reviews for finance and compliance reviews, process automation controls for TAD monitoring and reducing time lag, finance transformation, financial and operational audits, internal control over financial reporting, business process re-engineering, and so on. So, ladies and gentlemen, you will have the fortune of listening to the words of wisdom from Mr. Gurvinder Singh. But before I conclude, I would like to end with a couplet. The couplet which speaks of conflict in human minds. The couplet says, तमाम के तमाम शहर बसाकर सुकून के लिए गांव ढूंढते हैं. तमाम के तमाम शहर बसाकर सुकून के लिए गांव ढूंढते हैं. कितने नादान हैं हम, हाथ में कुल्हाड़ी लेकर छांव ढूंढते हैं. We all have to work in tandem with the best laid out practices to ensure that the results are manifold and up to the expectations. So I give the dais to Iprit Singh for further proceedings. Iprit, the dais is all yours, and let us listen to the dictate, to the lecture of C.A. Gurvinder Singh. Over to Iprit.
Thank you. Thank you, Nandaji. Before
Sir.
you start, Iprit,
Yes, sir.
before you start, Iprit, I believe this is your maiden address as a chartered accountant to the chartered accountants to your fellow members of the Institute of Chartered Accountants of India.
Sure.
So wishing you all the best. So this day marks a golden letter day in your professional career. So from the board, from all of us here, from all of us, all the members, we wish you a bright future, bright career. May you shine. And if I can tell one step ahead, may you outshine your illustrious father, C.A. Charanjot Singh Nandaji. Over to you, C.A. Iprit Singh.
Thank you, sir. Thank you so much. Good evening, ladies and gentlemen. A very warm welcome to all the participants of this insightful webinar on the topic of internal controls over financial reporting, organized by the Board of Internal Audit and Management Accounting of the Institute of Chartered Accountants of India. I would like to take this moment to thank the Institute and the board for setting up such an insightful webinar and giving us the opportunity to go home more enlightened. Today, we are privileged to have an esteemed speaker with us, C.A. Gurvinder Pal Singh, Please join me in extending a warm welcome to Gurvinder ji. Before we dive into the enriching session that lies ahead, just to set the context of the webinar, I want to delve into a fundamental aspect of financial management that forms the bedrock of trust and integrity in any organization's financial operation. The topic we'll explore is internal controls over financial reporting. Internal controls are the mechanisms and procedures put in place within a company to ensure the accuracy, reliability, and compliance of its financial statements. They are the silent guardians that protect against errors, frauds, and mismanagement. These controls encompass a wide range of processes from segregation of duties and regular reconciliation to robust documentation and accountability measures. In a sense, they create a system of checks and balance that not only safeguard the company's asset but also instills confidence in shareholders, stakeholders, and regulatory bodies. Internal control over financial reporting are not just about compliance. They are about transparency, accountability, and the ethical foundation of any organization's financial practice. They are the shields that ensure financial data is accurate and trustworthy, enabling informed decision making and fostering long term sustainability. As we delve deeper into the topic, let's remember these controls are not just guidelines to follow, they are principles to uphold. They are not just boxes to check, they are cornerstone of financial integrity. So let's embark on this journey to explore the world of internal control over financial reporting, understanding their significance and how they shape the financial landscape of any organization. Thank you for your attention, and let's begin our exploration. I will give a quick introduction about our eminent speaker of the day, CA Gurvinder Palji, who has more than 15 years of experience in assurance and risk management, ranging across multiple sectors such as telecom, sports associations, FMCG, hospitality. He has also been consultant in large consultancy firms across India. Also, he has special expertise in financial and operational audits, internal control over financial reporting, business process reengineering, and many pertinent areas. I welcome Gurvinder ji to take over.
Thank you, Vipreet ji. Gurvinder Singh ji, all yours, we're all waiting for you. Thank you.
Thank you, sir. And thank you, Vipreet ji, for your kind words. And describing the internal financial controls, you have kind of summed up, and you have cut short my job now. You have summed it up really well. Thank you for that. And good evening, everyone. Really blessed to be part of this session and having this opportunity to speak in front of such notable senior faculty members. Thank you, sir, for providing me the opportunity. So today's topic is around internal financial controls review. I'll just share my screen. Yeah. So I hope it is visible.
Very much, Gurundarji. Please go ahead.
Yes, sir.
So the agenda for today's topic is around providing a brief introduction about ICFR, and then how did it evolve? What's the regulatory framework around it? What's the meaning and importance of ICFR? While planning ICFR, how do we need to do the planning part and scoping part of things? And then the most important crux is how do we design the ICFR designing template and performing the real testing around it. So this topic would be taking most of the time, as this is the I would say most important topic of the session, and I would try to devote as much as time I could on this point, because it is very important in today's world that we all CAs do a thorough, detailed testing of ICFR, which helps the statutory auditors in evaluating the controls and overall forming the audit opinion. So, and then in the end, we'll sum it up around the conclusion side of things. So, to give you the background and perspective, how did ICFR evolve? The concept of audit committee was introduced in 2001 in the Companies Act, which highlighted the need of corporate governance in the companies. Then 2003 CARO was introduced, wherein the statutory auditors were asked to report on the overall framework of internal audit and internal control in the organization. Then for the listed companies, SEBI had introduced Clause 49 of the listing agreement, which again talked about the detailed corporate governance mechanisms and structure that needs to be put in place to the listed organizations. And finally, in 2013, the landmark Companies Act 2013, it introduced the concept of internal financial controls review, which was further modified in Companies Act Amendments Act 2015, and ICFR also evolved during that time in 2016. So, in terms of regulatory framework, which all regulatory authorities would say monitor the ICFR and IFC controls. We have Companies Act from the top, which is the guiding act for the IFCs. Section 134(5) subsection E of the Act places the responsibility on the board, and 143(3) subsection 1 places the responsibility on the statutory auditors to comment on the effectiveness and efficiency of the internal controls within the organization. Then we have SEBI, who is providing detailed guidelines around the corporate governance for all the listed entities. For banks and insurance agencies, insurance companies, so we have RBIs and IRDA who provide additional regulation and additional guidelines for performing ICFR testing. And then Institute itself has provided a guidance note whereby it has detailed out almost all the requirements that are to be performed while doing the ICFR testing. So that's the overall regulatory framework in India. And apart from that, there would be still other regulations which would be applicable. It could be certain location specific or certain company specific. So just to have a quick meaning, and I'm sure everybody is aware of this. Internal financial control means the policies and procedures that have been adopted by the company for ensuring the orderly and efficient conduct of the business, including adherence to company policies, safeguarding its assets, prevention and detection of frauds and errors, accuracy and completeness of the accounting records, and timely preparation of reliable information. Why I have underlined these words? I have underlined and kept these words as bold because these are the kind of words that are interlinked with the financial statement assertions that we are going to see in the next slides, whereby we are required to map all the financial controls, the internal financial controls, to the financial statement assertions around which we do the audit. We have to map all of them in the IFCs as well. A small task of difference between IFC and ICFR. So in Indian context, there is a difference. IFC is different from ICFR, and IFC is a much larger concept as compared to ICFR. While ICFR is more around reporting on the numbers that we are financially reporting. So it refers to internal controls and procedures that the company puts in place to ensure accuracy and reliability of its financial reporting. So whatever is being reported is accurate and reliable. In contrast, IFC is a broader concept. Whatever we are doing in ICFR, it is a part, and then apart from that, we have to also capture the operational controls and anti-fraud controls for IFC for commenting on the effectiveness of IFC. So operational controls would mean going into detail and doing understanding the processes itself. So we cannot say that procurement numbers that are appearing in the procurement, the OPEX procurement that we have done in a company. If we certify their number that these numbers are complete and are accurate and have supporting and backups. So that will solve the ICFR purpose. but we have to go to the essence of the operational controls, that as to how the vendor was selected, what was the documentation that was made, what are the policies and procedures around the procurement, what are the controls around getting the goods in the organization and issuing it to the manufacturing unit. So all those controls need to be evaluated in order to comment on the IFC side of things. So IFC in all is a much broader concept as compared to ICFR. Again, a small perspective of importance of ICFR. Why do we need ICFR, or why do we need to be more vigilant around ICFR from statutory audit perspective? Because it helps statutory auditors in a lot many ways, and it I would say reduces their burden of doing the testing and evaluating the internal control environment, internal control framework of the organization. It helps in their audit planning, wherein through ICFR they get to know the internal control environment, and then accordingly they can plan their testing procedures of substantive testing based on the this IFC report. And then risk assessments, again, it helps in assessing the risk of material misstatements in financial statements. Effective controls reduce the risk of errors, frauds, and omissions. Again, it would lead to improve the which could lead to inaccurate financial reporting. So again, it's a kind of risk assessment tool for the auditors, wherein they get to know about the company before they start the audit. Then, as I was saying, that placing reliance on the work done by the IFC personnel. So when we do the IFC testing, it allows the auditor to gain assurance over the overall design and the control environment of the organization, through which it can reduce the effort that he puts in the substantive testing. Then material misstatement detection, again, and audit opinion. Obviously, if there are any control lapses which have been reported in the ICFR, so it helps the stat auditor to evaluate those and to perform a deep dive into those aspects and suitably frame an audit opinion around those lack of controls or any assertions that were noted during the IFC review. So moving ahead on planning and scoping part. So planning and scoping, when we are planning the audit, when we are planning the review of internal financial controls, these are the key elements that we need to take care. We need to understand the business environment, how the business is operating, what are the external challenges, what are the regulatory challenges, what's the overall environment, what's the industry norm around that, so that and which all geographical locations it is operating. Because ICFR is not restricted to a head office review. You have to go to all the plants, all the branches, all the whatever depots or whatever, or majority of key depots, to understand what is the control environment right till the bottom last subunit of the entity. Identify the key financial risks. Now, this is the important task, because when we perform the IFC review, we have to be sure that we are able to understand the financial risk, because that's what we are doing the IFC also for, because it's an internal financial control review. So very important that we understand the financial risk in the company. Again, it has to be top key risk, top 10 risks which surround the company. And then we have to see that whether there are controls around that and all those stuff, which we would be discussing in the next stage of control testing. Walkthrough discussions with the stakeholders. We can't identify the risk or controls without having discussion with the stakeholders. Stakeholders does not only include the process owners, who are responsible for conducting the operations, specific operations, but it also includes the statutory auditors. It also includes the internal auditors, maybe the GST audit if it is done by some external guy, or any regulator report from a regulator that will help us to define what should be in IFC review and what should not be. Materiality and significance, obviously, as I said, that while focusing on branches, depots, and everything, and even the processes, we have to make sure that we are considering the material subunits or material processes which have a significant impact on the operations of the company. There could be a small department of a QA, with while maybe a 2 people team, but it could have a very significant impact on the whole quality of the product. So that understanding of the business needs to be there, that which process we need to take, which process we need to exclude, and there should be a reason why we are not including a process or a branch or a unit or whatever. And then last is critical IT applications. So in today's world, we cannot live without the IT applications. So having an awareness of all the IT applications that have been placed, so that helps us define the overall environment of IFC where we need to perform the control testing. Now, next topic is around the IFC designing and testing. Now, in this, we will be talking about in detail how should we be approaching the IFC right from the beginning. While I know that this IFC was introduced back in Companies Act 2013, and most of the companies have already defined the RCMs and checklists to evaluate the internal financial controls, but the new companies need to do that, and obviously the old companies as well need to reevaluate their controls, because controls keep changing in a dynamic environment. So the controls that were prevalent in 2017 may not be prevalent right now. So as an auditor, it's very important that we keep evaluating those controls, that whether those controls are still effective, still meaningful to be kept in this IFC testing sheet, or are there some other additional controls that needs to be incorporated in this? So this is the process overview. How should we go about the ICFR? First is document process, which I was just talking about, that we need to prepare a flowchart and have a detailed narrative around the thing, that how exactly is the process moving. So, for example, if we talk about the procurement process, I take the example of procurement process. So we need to understand from the process owner that how the procurement function, procurement department actually works. How does it start? How do they receive the requisition? How does that requisition gets converted into a purchase order? What all activities are done between purchase requisition and purchase order? And then after creating a purchase order, till the time of creating GR, and how do we communicate to the vendor? When the vendor supplies the goods, how do we track it internally? Who is ensuring inventory controls are in place, and the financially, how we are making sure that all three-way match and everything has been done or not. So this whole process needs to be understood and documented. Now, this is very important. Whole process controls may not be financial controls, but we need to understand the whole process so that we understand the universe, what we are looking at. And then on the basis of that, we define the financial controls, or rather the defined financial controls, we evaluate those controls for our review. But having said that, we need to be aware of whole of the universe so that we can have a better and a complete understanding of the whole process, and obviously, which will help us to identify key controls around that process. Second step is, as I said, identifying the key controls. So, as I was talking about the procurement process only. So, if we talk about key controls in the procurement process, there would be 5 or 6 different process, a PR process, then vendor selection process, then purchase order process, and then material receipt. Within those 5 sub processes within procurement, we would have n number of controls depending upon the size of the organization, controlling the specific sub process. So purchase requisition, we would have a separate guy creating a purchase requisition, separate guy approving that requisition. Then there would be a system of inviting the quotations from the vendor and evaluating the product or services. Based on that, we would be finalizing the vendor, preparing a purchase order. Then the person who would be creating a purchase order or preparing a purchase order or a contract would be different from the user department to avoid any conflict of interest around those things. So these controls need to be identified in each and every process and sub process, and then we need to map it to the financial statement assertions. So financial statement assertions, again, CEA, BOP, completeness, existence, accuracy, valuation, rights and obligations, and presentation. So these assertions needs to be evaluated because all the controls would be evaluated against these assertions. So we need to be clear that whether the control is around completeness, whether it is around the existence or valuation or whatever, and we need to map those controls. So mapping of the controls, identifying the controls and then mapping it to financial controls, evaluating the trial balance and ensuring that all the GL codes have been mapped to these financial statement assertions so that nothing is left as for evaluation in IFC. Then after that, the steps come of preparing the test scripts, wherein we define the test scripts, what all control needs to be tested, what frequency it needs to be tested, what sample size it needs to be tested, and who is going to perform that test. So we capture all the control assertions and then evaluate each and every control against those specific assertions. And last is obviously completing the test script. We perform the testing of the requisite number of samples and then document those testing results. Based on the results, we evaluate whether the control has passed or failed, and then basis of those controls, we evaluate whether the overall process is a pass or a fail, or how does it fare in the whole scheme of things for the company. So as I was discussing about document the process, so here's a brief synopsis of what things we should be careful of while documenting the process. Now, while documenting, we have to ensure that we are documenting it in such a way that any third person, when it reads it, so is able to understand. We are not making any notes for our auditing or for whatever. We are making it so that any independent regulator or anyone who reads it, he understands the process and he understands our methodology, how we have went about the things. So defining the processes is the most important part of the whole exercise. If we miss any control while defining, documenting the process, then the whole activity would be I would say the effort would have to be multiplied n number of times, because if we miss control at the beginning, we will not be able to evaluate its financial assertions. We will not be able to test that specific control in the test sheet, and obviously it may have a material impact on passing or failing of a particular control or a process. So identify. So how do we go about it? First of all, we identify the key persons that are responsible for the process. Who all are doing. Now, key person would include the process head. So if I talk about the example of again procurement, so it would be purchase head, and then he would be giving us the overview. He will not be providing us the detailed narrative. He would be, in a 1 hour meeting, we can understand that what is a process overall, how does it flows, and who all are involved in the sub processes. And then below the procurement head, there would be a team of depending upon organization, 5, 6, 10 member team who would be doing different activities. One would be coordinating with the business in terms of allocating the purchase requisition. Other team would be evaluating the procurement proposals, inviting the quotations from the vendor, evaluating those proposals on technical and commercial grounds, selecting those, and then forwarding it to legal team for drafting of purchase order, or having a standardized purchase order and drafting those terms and conditions in them. And then there would be it could be a part, same reporting could be same for the inventory guy to the procurement, or it could be different as well. Typically, inventory team is separate, and the procurement part is more around sourcing the material. So we need to get in touch with all these sub departments of purchase requisition, of sourcing quotations and everything, and maybe a legal team for understanding how does this process of creating a process till creating purchase order work. It's discussing, having a walkthrough discussion, having a test of one sample. There is no harm we pick up a sample and ask the management to run through us that sample, that for a specific sample. So for purchase of 100 units of X, could you run us through a sample that how did the purchase requisition come from the user department? How did we went about sourcing this thing? How did we evaluate the vendors? How did we finalize the vendor? And how did we created a purchase order in the system? And who approved it? So all those steps, we can do it in a test of one sample, so that we understand the controls that are in place for the organization for that particular process. The control should not be copy paste. Many a times companies have prepared an IFC document basis a standard wording document that they may have got somewhere or from internal reference or whatever, and they had created that. As an auditor, it is very important for us to understand each and every control and ensure that these controls are working effectively and exist in the organization. Now, it should not be the case when we complete the whole testing and we have certain controls which were not applicable in the company, but we have kind of either passed it or we have made it partially effective or whatever. So it puts the onus on us as an auditor that if we have not qualified that or not commented on that, or even if the control doesn't exist and we have allowed it to be part of IFC. So again, it's our responsibility to reply to the authorities or whatever, that why we have kept this control if that was not exercised by the organization. We cannot run away and say that the company has shared this this document. It was captured either by previous auditor or whosoever, and they believe that this control existed. We have to ensure that the control exists, and if there are any changes to the control, we have to ensure before the start of the IFC testing, we have to document those changes in the IFC document, get the management buyout that these are the controls that have changed, that needs to be updated in your test document, and then obtain a sign off on those, and then only proceed ahead. Again, after the walkthrough, we need to document the process. It could be done through a flowchart technique, through Visio, through PowerPoint, whichever thing we are comfortable in, or maybe we can prepare that in Excel. But the flow of process should be clear. The ultimate bottom line is that the flow of process should be clear to the auditor, that how does the process actually works. This needs to be captured, and while defining those processes, we need to capture the key controls. Now, these are the controls which we would be evaluating in the IFC. So that's why I said that documenting is important, and after documenting, it's very important for us that to identify each and every control, and which control is key control and which key is a non-key control, which can which if performed is fine, if even if not performed will not have any significant impact on the financial statement. And then once we identify these key controls, we need to document it in a risk control matrix. Now, risk control matrix, as I hope most of us are aware that it's a detailed narrative wherein we capture each and every risk in the organization, in a process, in a sub process, at to the last level of the organization. We go do a deep dive and define the risk. Against those risks, we have highlighted and noted key controls. So whatever process we have understood, it as an auditor we should ensure that whatever controls the company has put in are sufficient to mitigate those risks. If in case the company doesn't have a direct mitigation control, we need to suggest as an auditor, we need to have an alternate mitigating control that we need to suggest to the company, that these are the 10 or 15 risks that your company sure that we have some kind of control, else it will impact in our testing. So we need to be very clear that all the risks that a company is operating in, all the processes or sub processes, wherever there are risks, wherever there are processes, we have to evaluate it from the risk perspective, that all the risks, all the fraudulent risks, normal operational risks have been covered, and we have controls in place to evaluate against those risks. And then once we are done with defining the RCM, we need to have a follow-up meeting with the key persons, the key stakeholders, to run them through the processes, whatever we have defined. There would be iterations in the processes if we are drafting it for the first time. So while discussing with 10 different process owners, we may have got 10 different versions of story. And doing a test of one sample as well, we would have noted there are multiple overlapping controls. So it becomes very important that we discuss the final product with the stakeholder and understand that our understanding is correct, or does it need some more documentation, or does it need some more steps or activities or controls that we need to define or identify. Most important part in document process, that as an auditor or as a evaluating while evaluating the IFC, those people who are involved in doing the process must be heavily involved in preparing and maintaining the process documentation. Most of the small setup companies have that mentality that documentation is a part of finance team. So since audit is audit is to be conducted, audit has to be ensured by the finance team. So they prepare the responsibility of the finance team to prepare all these documents, the IFC, the processes, and everything. And in developing those processes, finance may or may not have the complete knowledge of a procurement process or an HR process, or the IT general controls, or the other inventory controls. They would have the knowledge of things impacting the figures, but not sure if they would be having that knowledge that how many quotations should be invited, what is the process of inviting the purchase requisition, because that side numbers are not involved. So maybe finance guy is not available and he may have skipped those steps. So it is very important that whatever process we are reviewing, the owner of that process must be involved in preparing and maintaining the process documentation. In case he is not, then again, as the company who is evaluating it, or as an auditor, it is our responsibility to get in touch with that specific process owner. Finance team may have objection, may not have objection, but again, we cannot fall short of our duties. We have to meet those process owners, understand the process, document the process in spirit, and then only proceed with the testing of internal financial controls. So this line is very important, and which I have seen many companies have giving a miss that the document being prepared by the finance, and sometimes I've seen auditors also relying on that, which is not correct, and it could open up potential future disruptions in your activities by regulators. Now, next step, again, identifying controls. So broadly in ISC, we have two level controls. One are entity level controls and the others are process level controls. What are entity level controls? Now, as the name suggests, entity level controls are, I would say, 25,000 above the above the sea line. The controls which we see in an organization must be there at an entity level. So, as we say that it's the tone at the top. So, entity level controls are the controls that have been ensured by the board of directors, by the committees that have been in place, put in place, to ensure that at an entity level we have those checks and balances in place to ensure that there are no mishappenings that are happening in the organization. Now, these controls are very different from the process level controls, because when we go to the process, we have detailed controls for each and every process. But entity level controls are more around rotating around the board of directors, the CXOs, and the top level management. So the key controls that I'm talking about are making sure that we have segregation of duties in place. As an auditor, you must have seen sometimes that companies have CFOs wherein procurement and HR report into CFO. So that's a conflict. Ideally, procurement head has to be different, and he cannot report into CFO. Why so? Because obviously, if these guys collude and if these guys report into one person only, so there is a possibility of managing the purchase order and obviously making the payment without actually order being placed or without actually goods being received. So there are checks and balances that have been defined in internal by internal audits standard board by internal audit standards, where we have to ensure that that these checks and balances are in place. So one is segregation of duties. Others is making sure that there is a proper authorization and approval mechanism in place for any significant decisions. We see board meetings, board minutes for all the significant decisions that have been taken by the company for purchase of an entity, for sale of an entity, for maybe sale of fixed assets. So all those things are captured in the board minutes. So that kind of authorization and approval needs to be in place, that we have a set of delegation of authority, I would say, wherein each and every person is aware of his role and responsibility, and making sure that he, if anything falls in his delegation, he has to approve it. And there should not be any there should not be any control lapses around approval mechanism. There are splitting of checks and splitting of payments that happen. So at an entity level, it needs to be ensured that all those authorizations and approvals are in place, and they are being followed in principle. Then reconciliation and review, obviously, any management for its internal purposes also would need regular account reconciliations, regular reconciliations of what numbers we have of inventory in finance versus what numbers we have in inventory department, reconciling it with the production and reconciling it with the sales that we have done. So those kind of reconciliations, review, and reporting mechanisms should be part of any management's control. Then next is around monitoring and oversight. Again, how the entity has set up the monitoring controls in terms of doing the internal audits, in terms of doing any management reviews, any internal controls review, corporate governance things. So how are the how is the management actually monitoring that activities that the people who are supposed to perform the activities are actually performing or not? The processes that they are supposed to follow, are they actually following it or not? Then around IT general controls, wherein management has to ensure that there are top level IT controls around password sharing, data security, and accesses that are up and running, and there are controls again defined at the top, that you cannot share any information outside the organization. If it's a listed company, it's a sin that if that control is not there. So all those aspects need to be identified and need to be documented in entity level controls, because we need to test these controls as well as in internal financial controls. So it's very important that we identify, and based on the complexity and based on the organization, as an auditor, we need to make sure that we are able to understand, evaluate, and identify all those controls. Now, if there are any challenges in identifying the controls, we need to have that discussion with the top management. Need to understand the processes. Again, as I said, that CFO of a company may be handling the HR process or the procurement process. That's a conflict of interest which we need to highlight as an review of internal control. So these controls need to be thoroughly understood and evaluated, and then obviously taken up with the management to help them mitigate those controls. Next are the process level controls. Now, process level controls are those controls which we see in the day-to-day operations of the companies. The processes such as typical processes in a company, procurement to pay, order to cash, HR, financial statement, FSCP controls, and manufacturing, if the company is manufacturing or a services entity for service review. So these are the various processes that are typically in the organization. Now, as I said in the beginning, each of a process have different sub processes. For example, HR, we talked about procurement. Now I'll talk about HR. So HR would have sub processes like employee recruitment, employee onboarding, then the payroll, then it would be the full and final separation, and then it would be any L&D and training or whatever. So these are the typical processes around the HR. Now within these processes, there would be within these sub processes, there would be controls that we need to again define and identify. The key process level controls that we should be evaluating should be around the authorization controls, how the transaction is particularly being authorized, who is approving it. Are there any maker checker controls around it? Are there any delegation of authority that's being defined? What are the controls in place to ensure that there is no splitting of check or splitting of payment or splitting of whatever to bypass the approval mechanism? Then the segregation of duties, again to provide to prevent the conflict of interest that we have discussed in detail. Within the organization, there should be within the process there should be different people doing different jobs, because the person who is doing say for example in finance, if a person is doing a cash, is maintaining a cash in a bank, and he is doing the BRS only, bank reconciliation is being prepared by the same guy only, then possibility of doing teaming and lading or doing any fraudulent activity in bank, or activity in a bank going unnoticed, changing the head, account head or whatever. So that probability increases. So there need to be appropriate segregation and segregation of duties around that. Then data entry and accuracy control, how we are ensuring that data that is being captured is accurate, because ultimately the financial statements are prepared from the software that we use. So we have to ensure that whatever data entry is being done, it is being adequately controlled, it is being reviewed and monitored as well, to ensure any errors that are uh, done during the course of data entry are there exists a process to identify those errors. These could be clerical errors as well, and these could be generally done manual fraudulent errors. But then there needs to be a control in place to ensure that that these data entry errors are minimized or reduced or nullified. Then approval and review control and reconciliation control. So reconciliations, we have BRS, we have the check reconciliations and all those things to ensure that that the process is working fine. Any gaps or any delays are being noted, reviewed, and approved by the management. Now, I'll talk about the financial statement assertions, which we talked that while developing the IFC, we have to ensure that these financial statement assertions have been taken care of, because ultimately that is what we are evaluating, and that is what we are looking at as an auditor and as an internal control reviewer. We need to ensure that there is a completeness of transaction. We need to ensure that there is existing accuracy, the transactions have been captured accurately, the valuation for the particular transaction has been done appropriately, and then if it's an asset or a liability, so we need to identify the rights of the entity. For the assets, there are the owner, the company has the rightful right of owning that asset, and liabilities have been recognized based on the obligations that are there for the companies at a given particular date. So, and presentation and disclosure, ultimately, all the things that need to be presented in the financial statement have been properly, thoroughly, presented, or they should be evaluated. The controls around those should also be evaluated. Now, each and every control that we identify, the process level control that we identify, have to be mapped against these financial statement assertions. Now, this activity is a detailed activity. We have to look at the balance sheet to understand each and every account that is there in the trial balance, the balance sheet, and map it to those financial statement assertions, and then further classify it into which specific assertion would be applicable on which process. So say this is a sample illustrative thing that is there. So there are balance sheet items, as all of you would be aware of: cash and cash equivalents, account receivable, allowance for doubtful debt. Now, which financial statement assertions are applicable in terms of existence, valuation, completeness, rights, obligations, and presentation? So what all assertions are applicable for this particular head, and then this cash and cash equivalent, for evaluating that, which processes we will be evaluating. We will be evaluating obviously treasury. We will be evaluating order to cash, which is our sale process, and then we will be evaluating procure to pay, which is our procurement process. Payroll and HR, obviously, there's an involvement of cash payout, and financial statement presentation. We would be evaluating. So this is the detailed mapping that we need to do while doing the IFC review, and then giving the overall rating of of that particular balance sheet item, that which all things are applicable, and whether it's a high, medium, or a low process or element that needs to be considered for the review. So this kind of detailed mapping needs to be done, and very often I've seen that this mapping missing, and ultimately the objective, we all know that IFC in India has been derived from SOX in US, and there was JSOX, there is JSOX as well. So in India, ICFR has been derived largely. It has been derived through those compliances only, and there is a very stricter compliance for these aspects of mapping. If we don't do mapping, so as an auditor, our test is incomplete, because we are ourselves not sure that whether all the balance sheet items that needs to be covered have been covered or not. So this mapping becomes very important, and again, if the previous auditor has not done it, or if you are doing it for the new company, you have to review that. And there could be changes again. Investment in subsidiaries, there would be no subsidiaries, say for example 5 years back, but today there may be subsidiaries. So we need to evaluate that. There could be accrued expenses may not have been the case in 2017, but now management has decided to accrue expenses, or whatever the expenses have been accrued, and they have been captured in the financial statement. So we need to evaluate. So it's a year-on-year exercise. If we have a previous year assertion, it's fine. Even if we don't have, we cannot run away saying last one hasn't done it, so we don't need to do it. We need to do it, and it's a year-on-year exercise that we need to do. Examples of assertions, say inventory. If we talk about, so what's the risk for the inventory that we are looking at? The inventory items owned by the business are not included in the GL account. Transaction and balances are not supported by the actual physical inventory, and inventories are recorded at the incorrect value. Now, which assertions are we looking at for these specific risks? For the first item, that items owned by the business are not included in GL account. Obviously, there is a completeness issue that there are missing entries into it. Then physical inventory is not there. Transactions and physical inventories are not reconciling. There's an existence issue that inventory doesn't exist, or it exists in a higher number, or inventory is recorded at an incorrect value. So it's a valuation assertion that we need to evaluate. Now, there would be controls against those risks that management would have defined and have documented. Like, inventory items owned by business are not included in GL account. So there is a control that physical inventory checks are being performed regularly, and for the stocks at company locations, as well as the packers third parties. And whatever adjustments are based out of those physical verification, that gets reflected into GL. So that risk gets mitigated. Obviously, we need to test that whether this risk, whether this control is working effectively or not. But then there is a risk, and then there is a risk, and then there is a element of control in that as well. Then the risk of transaction and balances not supported by actual physical inventory. So again, we are doing the physical verification and ensuring that whatever things are recorded in books of account are actually physically present in the various stock yards or wherever the company has stored the inventory. And in terms of valuation, so there is a control that management review to ensure that inventory is valued at lower of cost or net realizable value. And management reviews the inventories at least quarterly to identify any obsolete, damaged, or aged inventories, so that the valuation is true and correct. So, so these are the example of assertions. Against each and every risk, we have an assertion that we need to evaluate, and what's the control for review of that assertion. Now, the next step is developing the risk control matrix. Now, this is the most important thing, because ultimately, how we capture the things in risk control matrix is going to decide how we are gonna do the whole review. So while developing the risk control metrics, we need to keep certain things in mind, that each risk should have a control, and all those risks should be flowing from processes to sub-processes to sub-processes, and all the sub-processes should be interlinked. It should not happen that a logical sequence of any control, any process step is missing, and we haven't evaluated the risk or control against that. So a risk control template is used to document the key controls and map those controls against those financial statement assertions. And controls are identified through the walkthrough discussion that we had with the process owners. The first step when we were having discussion with the process owners. It provides us the understanding of what is done, by whom it is done, when and in what frequency it is done, and under whose direction and supervision and policy or whatever it is being done. Then, based on the testing performed through review of samples, test results are captured, and the control is captured. So this is the whole crux of RPM. That while developing, we have to ensure that these things are in place. All the controls that have been identified, or even if they have not been identified, if there is a risk in an entity, that should have a control, even if the management has not told us. So we need to discuss with the management that these are the open risks, that you haven't defined the controls. You need to define those, and then obviously we would need to test those controls in terms of working, whether they are working effectively or not. And very important last point was that in detail it provides us the understanding that what exactly is being done, by whom it is being done, what the frequency of being done, and whether it's a policy or a process thing or whatever. So that needs to be thoroughly documented in the RCM. Again, here is a sample risk control metrics that is there. So see how things have been captured. The key control reference number. So we are capturing that we have sequenced it. The key controls we have sequenced it, and obviously this would tie to the flowchart. Now KC1 mentioned here should be mentioned in the flowchart also as KC1. So that while reviewing the process, anybody reviewing the process understand that this is the first control that is there in the process. Before that, there is no control, and after that, there are the other controls that are there. So it needs to be thoroughly captured in the flowchart. Those key controls. Then the control description. That what exactly is the control description that is there, so for the risk that we had evaluated. So this is one part of the RCM, just to showcase that what all things we need to capture. There was more to it on the risk side of things, that I have not captured. So risk side of, I am only focusing on the control side of things for this discussion. So for those risks, what are the controls that are there? What is the number of that control that I have mentioned in the process? Balance sheet linked accounts. So this is the code that is there. The code which is for which this control is applicable. So all those codes have been mentioned. Say we're talking about management review of all the vendor contracts at least annually. So these are all the codes that we need to that are getting evaluated in terms of creating a vendor contract and making payments. And the control frequency, is it a annual control? Management review has to be annual control, or it could be quarterly as well. Is it an annual control? It's a quarterly, monthly, recurring, periodic, whatever control is there. And then mapping it with the financial statement assertions. Again, as I said, that each control must be mapped to the internal financial control assertion. If it is not getting mapped to the financial control assertion, then it could be that it is not a financial control. So we need to be carefully, identify each and every control and map it to those financial assertions. Then control description should reflect actual control activity as performed by the process owner. As I said in the beginning as well, that sometimes if the finance is the in charge of this document, those guys can do a copy paste thing, pick up the best practice from wherever, and then do a copy paste. But as an auditor, we need to evaluate that control, whether this control really exists in the organization, whether that control is working effectively, or whether the control that has been provided is complete, or does it need some modifications around it. So that activity needs to be done by the auditor. And in case any in case there are any gaps in the controls, then again we need to highlight it to the management and get those rectified immediately. Because ultimately, IFC document has to be up to date in terms of all the controls that are there in the organization as on the date of review of balance sheet that we are doing. Next is developing a test script. So once we are done with defining the RCM, then comes the actual testing that we have to do. Now, if all the previous steps are thorough and complete, then this is the most easiest part. But if our test steps are not complete, then this becomes the toughest part to do, to execute. So if we have not captured the controls properly, then each individual doing the audit. So, say example, as per ICI standard, we are doing a sample of 40 tests. 20 samples are done by A resource and 20 samples are done by B resource. They would be having different results because A would be relying on the processes that are captured in the this document, and B would be relying on the processes that have been explained to him by the process owner while he was auditing. So there could be a discrepancy in this. I'd say control testing if the controls have not been properly and thoroughly documented. So we need to ensure that all the previous steps have been done properly, and then doing the test script of completing the test script is the most easiest part of this IFC. It's a detailed work paper wherein all the samples of a particular control are tested. So now we're talking about the key controls. So there could be hundreds of key controls, and for those hundreds of key controls, we have to select a sample and we have to test it. So if there are 100 key controls for recurring frequency, so we would have to test a sample of 40 as prescribed by the institute and do 4,000 sample testing for the particular area. And so for selecting samples, ICI has prescribed the sampling criteria in its guidance note. All are required to go through that and understand the sampling criteria. We need to select the sample. Depending on the frequency of control, the number of samples have been defined that we need to evaluate, and so that aspect needs to be thoroughly understood by by reading the guidance note. Then, how do we capture the details in the test script? We define the sub-process, we define the control objective. What's the objective? Why we are actually performing this testing? What's the risk around that sub-process? And to mitigate that risk, what are the controls around that risk? Now, sample, say, we're going to location, so ABC plant, as and when, then sample size is 45. We can have a separate annexure for those 45 samples. And then the overall testing result, and whether it's a pass. Say, for example, if I have tested this, PR is duly approved as per DOA. This is the test attribute that I have checked. Whether this control is pass, fail. If it's a fail, then there needs to be a remediation plan and the reason for fail. All those things needs to be thoroughly documented. These are the sample descriptions. So, we need to capture the sample details, what the serial number, PR number, document date, attribute-wise testing, attribute 1, 2, 3, 4, 5, whatever attributes are there that we are testing for that particular sample. We need to capture it in detail, and then based on that, define the overall, define the result that whether the control is passed or failed. So while developing test scripts, following key pointers should be kept in mind for while developing the test script. It's characteristic of each control action to ensure its execution is consistent with the documented procedure and or management expectations. So that's what we discussed, that whatever testing we are doing is consistent with the procedure that is documented in this RCM, and management is in line with those controls that are captured in this document. Attributes necessary to evidence that the control was executed. So all the attributes that we are testing needs to be documented in detail to ensure that the control was executed, and we have thoroughly evaluated that attribute and that control. Actions undertaken to ensure the accuracy of any supporting information. So in this case, we need to evaluate any Excel sheet, spreadsheet, or whatever in terms of doing the sum totals and the data that is flowing through those sheets in our supporting documentation is accurate, or all the formulas and everything have been done properly or not. Then timing of the control execution, when the control is being executed, what are the acceptable tolerance levels under which no action is required, or with which the control can be classified as passed. So there could be small level delta errors because no process is foolproof. But then we have to define the tolerance level, looking at the materiality and thresholds that which what is acceptable at an organization level and what is not. So for a big size company, a deviation of 10,000 or 1 lakh may not be that big enough to create any big qualification. But for a medium sized company, 1 lakh deviation can be a high observation or a medium observation. Be clear and specific. Now, while writing the attributes and while documenting the test results, we need to be very clear and very precise, because this document is not for internal consumption. This document would be used by the statutory auditor. He needs to be clear of what as an auditor we have done, what all activities have we performed, what is the result of those activities, what controls have we evaluated, and whether those controls are effective or not. So if an auditor is reading, he or she should be able to understand it quickly, rather than using a circular language that we can say that while these controls were missing, but we had per discussion with management, we noted that there are certain alternate controls which in our opinion are sufficient. So this kind of language should be avoided. If the control is there, we have to be very objective that if the control is there, it's there. If it is not there, it's not defined. It is not defined. And if it is the control is working, either it has to work effectively or not work effectively. We have tested 40 samples to evaluate that. Now, if in 20 samples, 50% of the samples are failing, that means that control is not effective. That means that control is a fail. It is not working effectively. If there are 5 or 6 samples that have failed, but largely we look at a 40 sample and only 5 samples are failed. So in that case, we can still take that reliance that that the control is working, barring few exceptions, but the control is in place and the control has to be passed in that case. So these kind of clarity needs to be there as a internal control reviewer while defining the while documenting the IFC test results. Because if we are ambiguous in our results, the statutory auditor will not be able to place reliance, and ultimate objective of this exercise would be futile. So we have to be very clear in documenting those results. And again, include only those steps that are critical from financial reporting standpoint. There are n number of controls that the company has put. As an auditor, we are concerned around financial reporting. So, the financial controls and financial reporting. So we have to put the controls only that are relevant from financial control standpoint, which have a significant financial impact on the organization. So that should be very thoroughly documented. And then summing it up, I would say ICFR is a very critical component of corporate governance. It ensures the accuracy and reliability of financial reporting within the organization. While reporting ICFR compliance, structured approach should be followed to identify, assess, and manage risk to the financial statements in order to ensure the integrity of financial information while being presented to stakeholders. Again, as I said in the end, just before this, that while preparing this test script or while documenting the results, we should be very clear that what's the result of that control. If it's a pass, so it has to be thoroughly documented and categorized as pass. If it's a fail, we cannot be ambiguous in capturing it is a pass or a partially effective or something. We have to be sometimes management may pressurize us, but then it's our prudence that we have to ensure that if the control is not working effectively, we cannot pass it, or we cannot say it's a partially effective. Only if the control is working, then only we can pass it or do it partially effective. But as it's a black and white, either the control is passed or a fail, and then it's an auditor's prudence to define that whether it is working effective or not. So to sum up again, while doing IFC, these are in my opinion, I tried to capture the key points that are important as an auditor to keep in mind while doing the IFC review. While I've seen a lot of CAs while doing the balance sheet review, they themselves do the internal financial controls and in Caro they directly capture that the controls are operating effectively or what. Not sure if they are maintaining the document, but that's the whole objective. That's what MCA has rolled in IFC to ensure that organization has a good level of corporate governance in place, and then the auditor has evaluated that corporate governance. So these aspects need to be taken care of, and it's a lot bigger concept. I've seen sometimes the auditors doing the reviewing the IFC controls just before the closure of the audit, signing of the audit. Ideally, before the start of the audit, the IFC should have been completed. The audit has to start in April for the financial year. Then IFC controls should be, by 15th of April or whatever 10th of April, the IFC controls should have been tested, and they should start a month back, evaluating those controls. In order to ensure that all the controls, all the evaluations, all the assertions have been thoroughly documented and captured and evaluated, and then auditor can place reliance onto it. So that's all for the topic. I don't know if we can, if the speakers can ask the questions. So, Ayaz, if you can help me, if there are some questions, or how do we proceed ahead?
Yes, sir. There are some questions.
Okay.
Yeah.
So,
So,
if you can.
yeah. So one of the question which is quite common is, can we rely on management testing if they have appointed a consultant to test them on the behalf of management?
See, relying on the management is, ideally it has to be, again, audit is about independent and objective assurance. So it's the responsibility of the auditor if he considers management to be independent enough to do the audit. So, you can rely, but technically not, because, again, as an auditor, you are giving an independent and objective assurance. And if the IFCs, which are forming a base of your opinion in Caro, if it has not been done by an independent person, so not sure if, you should rely on that.
Correct, sir. So one of the question is, can you mention the auditing standard numbers that we need to keep in mind while doing ICOFAR?
So I can share that with you, and then probably, you can circulate to the members those reference numbers. But again, it is while doing the ICOFAR, one is the auditing standards that you need to be careful, you need to be wary of, and then there is the objective assessment on ground. There are standards, but obviously, the nature of transactions, nature of business is huge, and that is the prudence that you need to apply. That you need to be more careful around evaluating the controls, evaluating those processes around those controls.
There are some comments also that the PPT was quite comprehensive, and it was in all aspects covering all the aspects of ICOFAR. Sir, there's one more question which has just come.
Yeah.
They're asking that what do you mean by relevant controls? As in, they're asking that not all controls are for financial reporting, but are only relevant for the preparation of ICOFAR.
So I didn't get that question. Can you repeat?
So they're saying, what do you mean by relevant controls? Not all controls for financial reporting are only relevant for preparation of financial statement. Basically, they want to ask that when we prepare ICOFAR report while doing that.
Yeah. So basically, when we are doing understand that this is internal controls over financial reporting. So we are doing financial reporting and we are reviewing that. Now, so the controls would be different for a listed company, for a non-listed company. If we are doing a ICFR for an unlisted company whose turnover is more than 50 crores, so the evaluation of controls would be different. The key controls would be different as compared to the IFC, because IFC is a much more comprehensive, world, wherein all, I would say all the key controls are captured, and, operational controls are also captured around that. But ICFR is more to do with the financial controls. So we have to evaluate all the financial controls in ICFR, which for the enlisted companies is mandatory, above 50 crores.
Correct, sir. So one of the question which I have.
Yeah.
In your experience, what is the most common misconception that organizations have about implementing effective internal controls, and how can they overcome it to strengthen their financial integrity?
See, I would not say misconception in terms of implementing internal control. The common, I would say, still, there are companies in India that
there's some companies that don't realize the importance because they think that they'll conduct internal audit. Yeah.
So see, internal control. How did it evolve? It evolved. It started evolving around corporate governance. Corporate governance was introduced in 2001. And Satyam, company like Satyam got a Golden Peacock Award a year before it collapsed. Before Ramanathan Raju had made that statement. now, if you and I was I was auditing during that time, so I'm pretty much aware, and it was the start of my career during that time when that fraud happened. So first fraud in my when I became a CA, and if you carefully understand what all aspects were missed in that, these were the basic internal control failures.
Yes, sir.
BRS not being done, mismatch in cash balances and all those stuff. So these were the basic internal control lapses that were there. And these organizations realize, unfortunately, some of the organizations realize only when the fraud happens. Before that, they kind of are reluctant that, we have all control over the thing. Management has always been of that viewpoint. Of late, I'd seen, maybe because of regulatory environment or whatever, things have started to change. And obviously, the auditors themselves, have been very objective in their assessments. And, in fact, doing the audits, we are in touch with a lot of CAs who want that, proper IFC testing should be done in order to ensure that the company is compliant to that specific aspect of Caro, because it places a huge responsibility on the auditor while evaluating. It could be just a one line, but that's a very defining line in the whole context of things.
So the participants are engaging with the questions, and they have
Yeah. I think I've spared time for this. So yeah.
Yes, sir.
Great.
So there is a question whether work of internal auditor for testing ICOFAR may be accepted and used for reporting.
It can be to a certain extent. Say, for example, if I'm talking about entity level controls, for sure, yes, you can rely on that, but obviously not blind eye. Obviously, you have to evaluate, make sure that those controls, if an internal auditor fails in discharging his duties thoroughly, that does not, absolve you from resolving your duties. But, if he has identified certain exceptions and which are relevant, so you can obviously leverage that. But IFC is a different, I would say, concept, and internal audit is a different concept. There are overlapping things that when we do a process review, internal audit is more around operational processes and reviewing the operations, whether the operations are working effectively or not for the management. But IFC is more around whether the operations are working effectively and reporting the numbers as required in the financial reporting. So we can rely certain controls, yes, but not all.
So there's one more question. Is the risk control mechanism which we prepare is required to be published as a part of annual report or not?
No, it is not required to be published, but the auditor, the statutory auditor generally asks for this RCM because it's a working paper. So you are not required to publish that. So, but it is kind of a thing which an auditor relies on, and he would look at each and every control that we have tested. So, so obviously it has to be. That's why I said that the working papers need to be very precise and to the point and written very professionally, because some external person may rely on. If you are not the auditors of that company and somebody else is auditor, so he would be relying on that work paper.
Correct, sir. If I may say, the RCM acts as a paper for benchmarking what processes at least needs to be checked, and then we can dwell upon the further processes which we think by doing a walkthrough of the organization controls in respect of financial controls.
Yes. So it's like 2017, this 2016-17, this concept of IFC came, and most of the companies have developed the RCM during that time.
Correct.
So it's a good starting point today, but obviously the control environment has changed. There have been 6 years which have passed, 7 years that have been passed, and now the organization's control environment has changed. They may be working in different territories. So it's very important for us to annually evaluate those controls, RCM, and see if there are certain additional risks that have emerged. And obviously there are mitigating controls around it. And there may be certain controls that are now redundant, which were very much relevant 5 years, 6 years back.
Correct. So one of the last questions, which is very common, I'd like to have your wisdom on us and enlighten us, please. Sir, is there a requirement of doing IFC audit every quarter? That is before audit of quarterly financial statements or annual review may be done?
For listed companies, yes, kind of, because you have to split your processes. For unlisted companies, I would say annually before the closure is fine, because the director responsibility statement as well to be mentioned in the this thing. So probably listed companies, yes. You can obviously divide the processes. There are 7, 8 processes, sub processes that you are reviewing, the procurement, HR, finance, and everything. So you can probably divide it quarterly or something.
So, ladies and gentlemen, before we conclude this, am I audible? One second. I'm audible, yes.
Yeah.
Ladies and gentlemen, before we conclude this insightful session on internal controls over financial reporting, I would like to express our gratitude to our esteemed speaker, C. Gurvinder Palji, who has shared his invaluable insights and expertise on this crucial subject. It has enlightened us, and his deep knowledge and passion for the topic have illuminated the importance of internal controls in the financial reporting. His informative presentation has not only expanded our horizons in understanding, but also inspired us to embrace the highest standards of financial integrity within our organizations. We appreciate your dedication, sir, for sharing the knowledge and your commitment to upholding the principles of transparency and teaching us how to be accountable in these financial practices. On behalf of all the attendees, I extend our sincere thanks to CA Gurvinder ji for his time, expertise, and engaging presentation. We look forward to more opportunities to learn from his wisdom in the future. Let's give a virtual round of applause to sir.
Thank you, Preet. Thanks, and thanks to the committee for providing me this valuable opportunity to present. Thank you.
Thank you. I also extend sincere thanks to the board, the institute, and the technical team, Arun Agarwal ji, and everyone who has dedicated their time and efforts to make this a success. Thank you, sir.